Wall Street economists projected a gain of 3.3% in the fourth quarter growth for the U.S. economy. That's according to the latest Bloomberg survey. Well, will today's revision to 2.8% change some minds? Well, our next guest says he'll probably make some revisions in the next few days. He is Scott Brown, chief economist at Raymond James Associates. He's also a Bloomberg best forecaster. Scott, good to have you back on this Friday. Well, let's talk about today's report. The market has been focused on so many things outside of the U.S. that almost the sort of U.S. economic indicators seem to have fallen by the wayside a bit, at least in terms of creating a lot of movement. But what about today's report?
Well, it was a bit disappointing, but not a complete disaster. We saw a downward revision into consumer spending. That was largely anticipated. I think the big surprise is that we didn't get any real revision in inventories or net exports. Those had pretty big moves in the fourth quarter, and those estimates were essentially unrevised, very close to what they were before. We did see a downward revision to expenditures in state and local government. That is going to be, I think, a consistent theme this year, where those budget pressures are still going to weigh on job growth overall. You're seeing a lot of states laying workers off. We think it's good that the governments are leaner, but in the short term, these people have families, they have homes, and so that's going to put some downward pressure on the economy. Not a lot. So, Scott, but more importantly, I think.
Let me jump in there, though, and talk to you about the downward revision and the effect that the states have on that potential revision. We're going to talk about oil in just a moment and focus on that. Clearly, that's having an impact on a number of economists and what we're seeing. But that's yet to be seen or yet to have translated through in terms of GDP numbers. How much getting back to the states, will that impact your revision?
Well, certainly we expected the state and local government to be a drag on overall growth this year. Certainly not enough, anything close enough to push us into a recession, but it's not going to be helpful for the economy. Normally, we'd be adding about 20,000 jobs per month in state and local government. That would be consistent with growth in the overall population. Over the last 12 months, we've been subtracting 20,000 jobs per month. So that's a pretty big switch, and there are multiplier effects as those people take their paychecks home and they go out and spend it. So if they're not spending that money, that's somebody else's income. So again, there's going to be a bit of a multiplier effect. Again, it's not going to throw us into a recession, but it is going to make the recovery a little bit softer than it would be otherwise.
All right, let's switch to oil, because there is a real risk here, right? We've heard various metrics on what various percentage gains in oil will mean for GDP going forward. Where does oil have to settle out for this to be a non-issue? Right now, I think NYMEX crude is trading right around $98. It's been hovering at that level, seems to have stabilized a bit. What's your biggest fear?
Well, certainly the impact of oil prices on the economy depend on the magnitude of the increase, as well as the duration of that increase. Brief spikes in oil prices don't necessarily have to have much of an impact on overall growth. Now, if this increase that we've seen now is sustained, that may subtract a half to a full percentage point from GDP growth in the first half of the year. Again, that's not enough to throw us into a recession, but every little bit helps at this point. We were looking at GDP growth this year probably on the order of 3.5% to 4%. Maybe those estimates start to come down to around 3%. That's not really going to be enough to push the unemployment rate down. Even at 3.5% to 4% growth, we didn't really expect a whole lot of improvement in the unemployment rate this year. So that's really unfortunate, because the job market is still, a big factor in the economy. We've lost a lot of jobs during the downturn, and it's really going to be a number of years before we start to regain those jobs.
Let's talk about also food prices. I mean, we have seen wheat sort of give up some of the gains that we saw earlier in the year, but food prices, the USDA just lifted its 2011 food inflation forecast, right? So they're looking for higher food costs. We've been talking about that sparking many of the events that we now see in North Africa and the Middle East. Is the Federal Reserve sort of wrong to not take into account energy and food inflation?
Well, I think they do. They do look at overall inflation. I think the main focus, however, is the underlying trend. With food and energy prices, you tend to see, short-term movements where you get an increase and then things either level out or fall back down. And that's particularly true in agriculture. We've had drought conditions in Russia and China now, pushing wheat prices higher. You're seeing cotton prices up substantially. But if you look out in the futures contract, you generally expect to see more planting going on. better crop results in the future, pushing those prices back down. Now, if you have some sustained increase in either food or energy, eventually that could feed through to core inflation.
How long how long is sustained, though? I mean, food prices have been rising for quite a while now.
Yeah, I would say more than a couple of quarters. Over the last 10 years, we've had a number of increases in oil prices. And what you tend to see is that this is not like the 1970s, where you had an oil price shock that quickly fed into wage inflation, and then you had these wage pressures sort of feeding inflation on itself. In this case, we've had a number of oil price increases, and we tend to see these not transfer to higher wages. We tend not to see this boost core inflation. And I would suspect that that's going to continue at this point. So inflation expectations are still pretty low at this point, but you do have a lot of increases in healthcare costs. You're going to see higher prices at the pump. We expect another 30 cents or so increase in the next week or so. And these are going to weigh against consumer spending, particularly against those at the lower end of the income scale.
All right, Scott, thanks for joining us today. We're going to have to leave it there.